Granted, the trend is still going on. It could have gone from 5 to 25, and you're getting in at 25 going to 100. You don't know that. You really do not know where the trend will end, but you must know that if you're getting at 25, you're going to get out at 23. And he's saying that's exactly what you can't do inside of a mutual fund. This is the How to Trade Stocks and Options podcast, brought to you by 10MinuteStockTrader.com, where we cover finance, stocks, options, entrepreneurship, education, and money. And here's your host, voted one of the top 100 people in finance, Christopher Ewell. Hey there, traders. Welcome back to today's How to Trade Stocks and Options podcast. Today, we have a special lesson for you. I'm putting it here on the podcast because I really believe that this is going to provide you massive, massive value. And that's what I'm trying to do here. And hey, listen, if this podcast was useful to you at all, I really highly suggest that you go check out the full trading course at AIStockTradingSystem.com. That's AIStockTradingSystem.com. Markets are people. People are predictable. Outlier can show you how to track market fear and greed with artificial intelligence on over 1,300 of the largest market cap names. Visit outlier.com to learn more. That's OVTLYR.com. They have a free pilot program for the rest of 2021, so you can get access to right now at OVTLYR.com. That's OVTLYR.com. Hey, make sure you subscribe and hit the bell so you'll be notified every time we give you more tools, tips, and tricks to help you trade faster and trade smarter every single week. Hey there, traders. Welcome back to today's How to Trade Stocks and Options podcast. Today, we're going to be learning from Jack Bogle, legendary Vanguard founder, about the one mistake 99% of investors make. And I love doing these YouTube commentary videos, mainly because they're fair use, and we get to learn a lot from these people who have been around for a while. We are so blessed to live in an age where we can do that. So let's jump right in and learn from the man Jack Bogle himself.
Is it appropriate, in your opinion, for an individual to buy stocks? Is there a level of expertise or interest, an amount of time you should have, or capital, or it should be a side frivolity in a base portfolio of index funds?
That last sentence captures it best, and that is, you should have a serious money account. I might even call it a boring money account, where you put money in the stock market index fund and balance it out a little bit with some bonds, depending on the age and so on.
Ooh, I like that. A serious money account and a fun money account. That's really, really smart. That's definitely something I do. I have my trading portfolio and I have an investing portfolio. And I think that's exactly what he's talking about here. That's smart.
And don't look at it. Don't look at it for 50 years.
Don't look at the investing. Okay, I agree with that. And I agree with that 100% because I do have a long-term investing portfolio and I think everybody should. And when someone, like when the market goes down and they're like, oh, I need to go check my 401k. Don't do that. Don't. That's part of the investing process is the dollar cost averaging, which is one of Jack Bogle's main things. But you know, you've got to be smart with your long-term investments. Don't go and open your 401k account really ever until you're ready to retire.
Peak. But when you retire, open the envelope.
There you go.
Be sure a doctor is nearby to revive you. You'll go into a dead faint. You can't believe there's that much money in the world. And that's where we fool ourselves. That's a serious money, boring money account. We have a gambling culture here in this country. Maybe every country does. You see it in its finest manifestation, or maybe I should say worst manifestation, in the lottery, state lottery. Las Vegas contributes its share. The races contribute their share, the track, and always just gambling, where a whole lot of people bet their money, and a whole lot of people take their money out, and the croupier wins. The house
3
wins.
to 20%,
yeah,
whatever
it is.
I think he's saying that the house always wins, and moving investments around, moving trades around. If you don't know what you're doing, the house definitely wins.
You put $1 in,
I'd say have a funny if you have the gambling instinct, and most people do. At least start off. I'd say start off with an index fund, period, and for 5 years don't do anything else, and then look around and see what's happened in the 5 years. See how it felt when the market dropped 50%. See how it felt when it came back. What's happened? I'd say start off with an index fund, period. And I'd say have a funny if you have the gambling instinct, and most people do. At least start off. I'd say start off with an index fund, period, and for 5 years don't do anything else, and then look around and see what's happened in the 5 years. See how it felt when the market dropped 50%. See how it felt when it came back. And those 5-year periods are going to be very different for one investor and another. But
he makes a really great point here. This is not trading. This is investing. Put your money in an investment account and don't touch it for 5 years and see how you feel at the end of those 5 years, right? I mean, if you look at any price of a chart over time, it basically goes from the bottom right to the, or bottom left to the top right. And that's kind of what he's saying here is that, put it in an index fund, sock it away, and don't touch it. And, that's not the trading style that we talk about a lot on this show, but it definitely is an investing style that makes a lot of sense, and certainly one that I do myself.
Because they're all, over time. But then when you get there, 5% in the funny money account.
What would have happened to Warren Buffett if he had done that? He would have, a tremendous amount of value would not have been created by his understanding and ability to evaluate a business for investment.
Well, name two.
Well, Longleaf, you mentioned Longleaf, dodging
Cox. They don't have the sensational returns. They may probably have something above par returns, but maybe a little bit below par from time to time. Mm-hmm. So, then don't forget in Warren's case, he wasn't running a mutual fund. Mm-hmm. The mutual fund is a badly structured business for investment management.
Ooh, this is
we say, and this is the way it has to be really, you can take your money out whenever you want, and you got to be ready to put it in whenever you want. And so you ride on these waves of optimism and good performance, and the money comes in up here, and then reversion to the mean, which is a big part of my recent book, a big part of the final chapter of my recent book, called Clash of the Cultures, and it's happened everywhere. It's happened in Magellan Fund. It's happened in T. Rowe Price Growth Fund. It's happened in our old iVest Fund. It's happened in Fidelity Trend Fund, which Ned Johnson happened to have run. It happened in CGM, all the hot funds. They're all in there for the last 25 years, and they all look like this. You put them over each other, looks like the Himalaya Mountains. The reversion to the mean is a constant pattern.
For the individual, I'm just going to poke around.
I feel like he had a point that he didn't get to there. That's a loss to all of us, because Jack's passed on at this point. But I feel like he was going to make a point
around here a little bit just to get your full philosophy. For the individual, it's unlikely that you're going to hit the mountaintop of the Himalayas with your portfolio.
Oh, yeah.
So you may not have to ever see the other side of the mountaintop unless you have so successfully invested that your personal account is moving up in a $1 billion.
Let's say you bought Magellan before it was for sale, which is where that record begins, by the way. There's a lot of phoniness in this business. But you're going to enjoy the mountain. Mm-hmm. Now, you're not going to know it's a mountain. Mm-hmm. But when that mountain gets up there, you think, my God, I found the Holy Grail.
And now I'm really going to go all in.
And now I'm going to go all out. Mm-hmm. So there's a lot of behavioral kind of stuff, not to use too fancy a word.
So he's talking like, imagine it's a trend. The mutual fund is going up on a trend. We love trend trading around here. That's kind of one of the things we do. But imagine that, rather than getting in when the trend is changing, right? When you've got your lowest risk point, you're getting in at the top, where you've got your highest risk point. That's exactly what he's talking about here. Granted, the trend is still going on. It could have gone from 5 to 25, and you're getting in at 25 going to 100. You don't know that. You really do not know where the trend will end, but you must know that if you're getting at 25, you're going to get out at 23. And he's saying that's exactly what you can't do inside of a mutual fund.
The mutual fund industry, interestingly enough, Tom, there is no behavioralism in the field of stocks generally. How could that be? That is because I'm a dumb behavior. The guy that buys my stock from me is a smart behavior. We offset each other. I mean, it's not as if I can make a behavioral mistake without somebody else making a successful behavior thing, the other side of the trade. So, I think we take a lot for granted. We listen to all these theories, and big, old, boring indexing is the answer.
Have you ever bought individual stocks and or actively traded funds? And if so,
So I don't feel like this was the mistake he's talking about, the number one mistake. But he did say the number one answer that he feels, big old boring, what did he call it?
What do you look for?
Is these theories, and big old boring indexing is the answer.
Big old boring indexing is the answer. So basically, buy the SPY, you're good to go. End of the story, end of the podcast. No, I'm just joking. But for investment's sake, something you're going to put away forever makes all the sense in the world.
Have you ever bought individual stocks and or actively traded funds? And if so, what do you look for in those investments?
Well, when I came into the business, I had friends in the brokerage business, and I bought this and that and the other thing. And then I had a broker. And he would tell me this was good, get out of that and get into that. And it wasn't that they did badly, which was, of course, what they did. But it was I just couldn't stand to have my phone ring when I was trying to do my work. So I haven't owned an individual stock since, let me say, 1960. I don't know exactly, a long, long time.
All right, interesting video to talk about there, right? The number one mistake that investors make. He really didn't cover the mistake. Maybe it was the mistake of trying to bounce into lots of other investments, lots of other stocks, or maybe his mistake that he's trying to convey is not doing the passive long-term indexing. And you know what? I love his idea of having 2 separate accounts. It's definitely something I do and I advocate for. So you know what? That's a huge lesson from Jack Bogle today. Number 1, have 2 sets of accounts, right? Your trading, your fun account, and your long-term investing account that you're never going to look at, but you always perpetually contribute to. And bonus tip, if you have a 401k and your company contributes to that, you need to max that out, because they're basically giving you free money. And if you're not maxing that out, you're not getting as much free money as you possibly can. Definitely something I learned in my personal experiences. So, you know what? I hope you found that useful today. There was definitely a lot that we covered thanks to Jack Bogle in this video. And, if you found this useful at all, make sure to smash the like button, as they say. Share it with somebody who needs to hear it, and subscribe. And make sure you come back next week for more tools, tips, and tricks to help you trade faster and trade smarter. And I'll see you in the next episode. Okay, so what'd you think? That was pretty incredible, right? Now, if you like that, that's only a taste, only a sample of what you're going to find in the full AI stock trading system. And I really highly encourage you to go and check this out. Obviously, you are interested in learning and how to trade, and that's why you're listening to this podcast. Now, I'm going to take and download my entire trading system that I use day in and day out onto you. And the only way I'm going to be able to do that is over at the AIStockTradingSystem.com. You're going to get phase 1, 2, and 3, several bonuses, and on top of that, I'm going to walk you through over a dozen trades that I put on inside of my account, holding your hand and showing you exactly how I got in, how I got out, how I use the artificial intelligence data, and how this could work inside of your own trading portfolio on a daily basis. So make sure you head on over to AIStockTradingSystem.com. That's AIStockTradingSystem.com to learn more and to get started and to download my decade plus worth of trading experience into your hands so you can start using the AI stock trading system today, the 5-step system to take the guesswork out of trading. Hey, if you like this video, let me know by leaving me a like below, and then subscribe and share it with somebody you think could use it as well. Be sure to comment below with your biggest takeaway from this episode and any suggestions you have for future episodes. And finally, make sure you watch these other videos to help you trade faster and trade smarter, and I'll see you on the next episode.